Hey everyone, it's Vish here. As we head into the new year, everyone running a diversified portfolio is asking, how do I prepare best for what's ahead of me? Good news, because today I'm joined by one of the best in the business. Alex Ventelon is the Head of Investment Strategy and Solutions at Morgan Stanley Wealth Management Australia, and he is going to break down the investment house's asset class outlook for us. Alex, welcome. Good to have you here.
Thanks, Vish, and thanks for having me. And yeah, it's a great pleasure to be here today. It's going to be a great year. Next year again, full of action, probably.
Great year. Well, that's a good start to our first question, because I have read through your report. So Morgan Stanley is risk on. So from a multi-asset perspective, what's the single biggest driver behind your overall risk on tilt for 2026, and how does that shape broad portfolio construction for Australian investors?
Yeah, it's a broad but important question. Of course, I want to say, first of all, disclaimer: everything I'm going to say today is general advice by nature. But yes, I think what is very unusual is this kind of triumvirate of monetary policy, fiscal policy, and capex expenditure in AI that are all going to be very supportive for the stock market. We think fiscal is going to be expanding in the US. We saw that with the OBBA this year. Is going to continue into next year. Monetary with a few more rate cuts. And also AI capex boom still in full swing. So it's very rare to have this confluence of positive factors playing all together, especially for monetary and fiscal outside of a recession period. So this is quite unique, and we think is going to boost the equity market, especially in the US, for another year.
Okay, so positive on equities, specifically positive on US equities. Let's turn to fixed income. So the RBA expected to be on hold for a period. Some economists thinking a rate hike is in order, some still predicting a rate cut. But against that, how are you positioning for in terms of duration and your sovereign bond exposure, given the unusually long pause, and what opportunities or risks does that create for Australian fixed income investors?
Yes, well, another very, very broad question, an important one. I think, let's break it down, right? I think first and foremost, I don't think that it's a done deal that the RBA will stay on pause for the foreseeable future. In our case, we still see some noise in the data. We saw the recent GDP print coming in below expectations. Not everything is strong about the US economy. It's an economy that is muddling through okay, but we think that, especially on the job creation side, we could be falling short of expectations, and in which case the RBA could be very happy to bring interest rates back to where we think neutral is, which should be around 3.1%. What it gives for Australian rates investor and bond investor more broadly is a setup where you have to be cognizant of global rates, and global rates also are going to come down not by much. So we're looking at rates coming in the first half of the year before sort of backing up. Hard to make very hard asset allocation decisions. What I would say is that people would be well placed to be owning global bonds, global government bonds, especially in US and Europe, where there's going to be more, I wouldn't call them certain, but more probable rate cuts, and bond yields are going to come in. And then continue to play floating rates in Australia, and credit in Australia, investment grade credit as well, which is likely to be well supported by limited issuance and a stable sort of rates market.
Okay, so let's go deeper a bit into the credit market side. So credit market's going to be very, very busy next year.
Yeah.
There's these things called the AI companies issuing a ton of debt to build out the AI infrastructure. So where do you see the best relative value in global credit markets, and how should investors think about the investment grade credit versus the high yield grade credit side of things?
Yeah, I think thanks for putting the light on this asset class, because I do believe it's going to be a pretty unusual year where we are very positive on equities, but we're a bit more mixed on credit. Credit had a very strong ride. We saw that investment grade credit in the US, the spreads going to the low 70s, which is extremely unusual, the lowest probably in the last 30 years. Going into next year, the conditions are still going to be quite favorable, where, with interest rates falling and moderating growth, moderating inflation. But like you mentioned, there is this wave of issuance coming to fund the AI spending artificial intelligence spending. Our view is that this 3 trillion of AI spending to be financed in the US, 1.5 is going to be funded out of cash flow, and then 1.5 trillion to be funded out of the debt market. A lot of that will find its way in the investment grade bond market over the next couple of years, but more specifically next year, we should see about $1 trillion of net issuance in the investment grade market. That is 60% rise year on year in net issuance, whereas we think that the net issuance is going to be broadly stable in high yield. So in high yield, you're going to have higher yield. You're going to have probably stable spreads, not widening like in the investment grade space. And still very good economic conditions. So overall, in terms of asset allocation, what we've done is we've double downgraded investment grade bonds to neutral, right? We'd rather take the risk within equities, and we're happy to hold a modest weight towards the high yield segment of the market.
Okay, let's turn to currencies. A long time since an Australian traveler has had a cheap US holiday. The baseline view is, from Morgan Stanley's perspective, that the US dollar becomes weaker in the first half of 26, then stabilizes and the AUD goes a bit higher. How important is FX positioning in your asset allocation outlook for 2026, and are you running deliberate USD or AUD tilts across the portfolio?
Yes, another key sort of area of focus for us. I think, in the past few years, one of the things we probably got right was this overweight to international equities versus domestic. We see more growth offshore versus Australia, and especially in the US. But as a result, as investors' exposure to offshore assets, goes up in size, then the question of hedging, becomes very prevalent. And what we've done is just hedge an increasing share of the portfolio, right? And our hedging levels have gone up. We will probably continue to hedge, given we are expecting a bit more strength in the first half of the year. But I would say from here, given we are trading 66, 67 cents on the dollar, we are expecting to be at 67, 68 by the end of next year. So, we should go back to where we are right now. The need for additional hedging is, I think, mostly for tactical investors, for long-term investors. As we get closer to the equilibrium rate, I think there's less of a need. So a portion anywhere between 30 and 50%, I think, makes sense. But hedging too much would eat into the diversification properties of the portfolio. So we're trying to find the right balance.
Okay, makes sense. Let's move to REITs. You've gone from overweight to equal weight. How do you view property and real assets today? Is it an income opportunity? Is there a valuation risk? A bit of both? And what role should they play in a diversified portfolio?
It's always a tricky one with REITs, because REITs, in the end, they are listed business, they're stocks, they are equities, right? And some see them as alternatives. It's not really our view. We see them as stocks, and they are very interest rate sensitive. What we found as well, and it was raised by our colleagues in institutional research, is that even Australian REITs are more and more sensitive to the trajectory of US rates. And given in terms of bond yields, we are expecting also yields to be weaker in the first half and then back up in the second half. This massive tailwind of lower interest rates and lower bond yields is going to fade into 2026. So the valuation aspect, I don't think is going to be as much at play. We know that when we look under the hood, some sectors like high quality office, etc., will see some valuation recovery, but we don't think it's going to be a massive swing back up. And then the question is, what is the outlook for rents, which we expect sort of to grow up, but again, it's a very mixed bag, and we're not expecting a sort of a massive jump up in rents. So we think that investors will find better equity opportunities within the listed stock market, and maybe if they're looking for yield, high single-digit type yield, they will find better opportunities within alternatives.
Okay. One of Australian investors' favorite plays is, of course, commodities, one of the top performing sectors on the ASX this year. How do you justify your commodity allocations for 2026? And are you looking at commodities more of a cyclical play or a long-term structural play, given all the excitement we're seeing around critical minerals?
Yes, yes. Look, there is always two outlooks for commodities. I think there's the 5 to 10 year, and we all know that in the world where energy transition in particular and data center build up is going to be more important by the day. There will be a strong demand for commodities, whether it's on the construction side or on the device build-up side. So clearly, you mentioned critical minerals, but also copper, etc., the very basic base materials. For the next 12 months, I think it's really a question of supply, right? We want to be where supply is constrained because growth is going to moderate. Global growth is going to keep moderating in the next 12 months. So it's a matter of being positioned in markets where there's supply constraint. We see that in aluminum. We see that in copper, for instance. The mother of all commodities, the oil price, we think will be challenged next year again because oil demand will remain quite tame whilst oil supply, OPEC and non-OPEC, will keep growing. So it will find itself into an oversupply state, which will probably contain it around $60. Where we see value from 2 points of view. One is potential capital gains, and the second one is diversification, is gold. Right? We've been writing extensively about gold. We think that the tailwinds behind gold are not going away, whether it's about inflation hedging, whether it's about de-dollarization, concerns over governments, policies, and orthodoxy around public finances. All these concerns are not going to go away. There's still going to be also geopolitical concerns, and they're all sort of supportive of the gold price, and that's why central banks have been buying so much of it. So we see value in owning gold next year, but on a risk-adjusted basis, if you want to be risk-on, it's better expressed via equities rather than cyclical commodities.
Okay, the golden run to continue. So your global outlook highlights the enormous financing demand for AI infrastructure, much of it through private credit and securitized markets. Now, we talked about AI financing and investment-grade debt, but from an alternatives perspective, are you increasing exposure here, especially to things like private credit, infrastructure, or real assets to capture the AI capex wave?
It's a bit twofold. The positive is that there is strong demand, there's strong dry powder in private equity or private debt. But this very abnormal year or potentially years in terms of issuance are going to make the spreads move, right? The prices will adjust in private credit as well as listed credit, in our view, to allow for this massive issuance. As a result, it is likely we see a bit of widening in spreads in those concerns, a market which will put a little bit of downside pressure on prices. And so those investment tied to AI build-up, likely on the debt space, are going to be undergoing more of a transition year, if you will, right? And we're coming out after 2 years of very solid returns on the asset class. It should be probably a more of a transition year. I think private equity is better placed to capture those opportunities. Remember, we are expecting also deregulation to be a strong tailwind for the economy, the markets, and the M&A activity. We should see another year of recovery within M&A. Private equity will be front and center. And also with interest rates going lower, this all benefits the private equity market. So look, we're very reasonable around our expectations. We're not expecting booming years type scenario, but we think a solid year across the board. We remain cognizant that the exit market is still a bit mixed. So the fundamentals are solid and the balance of risk is rather positive. So we're happy to be more on the private equity side than the private debt, although we will still maintain an allocation to private debt.
Okay, no multi-asset class conversation is complete without cash. Cash yields remain attractive but are expected to decline as policy rates normalize. How are you advising clients to think about their cash allocations in the context of a fairly positive year for risk assets next year?
I think it's cash has to be liquid in this environment because we have appetite for still for taking risk, and we're also happy to take some illiquidity risk, right? So it is important we keep a buffer in the portfolio of liquid assets, especially cash, yielding a very decent amount, but then have the capacity to reallocate capital, right? Like I said, I thought this would be a great year, 2026. I'd say probably not just in terms of our expectations of market return, but it should be a busy year, I should have said, a busy year. We still think there's going to be volatility. There will be dips in the market. So for our clients, if they want to participate, not everybody is fully deployed, I believe, at the moment. So it's important to keep a bit of cash on the sideline that is not yielding zero and be ready to deploy when we get one of those dips.
Okay. Let's move on to portfolio risk management. Australian equities trading on forward earnings multiples of close to 20, well above long-term averages. What risk management levers, such as duration, FX hedging, alternatives, volatility management strategies, are most important in 2026 in the context of multi-asset portfolios?
It's another very good and broad question. I think we always consider portfolio risk management and diversification as going through a number of levers. As I mentioned, I think even though we are positive on the Australian dollar, we'll like to keep a good portion of our equities and hedge for diversification benefits. The Australian dollar tend to give us this ballast. Gold does that at times as well. And we think because inflation is going to continue to normalize over the next couple of years, then the ballast effect of government bonds will be back at play. So I like to keep a blend of those three in our portfolios to manage the various exposure of the portfolio and have a good risk reward at the total portfolio level. Now you mentioned volatility strategies. I think it's hard to make a call as to where volatility is going from here, but certainly, like I said, there's going to be spikes involved, we think, in the next 12 months, right? And some clients will want to use that as a dip to be bought in equities, and some will want to use that differently, maybe via structured products or the like. So there will be also a time and a place for those type of exposure in a client's portfolio.
Okay, so lots to unpack there. Alex, final question. Out of all the ideas you have, if you could only make one major asset allocation shift in 2026, what would it be in the context of multi-assets?
Well, I think as unsurprising as it will sound, I think it's just buying equities and US equities. I think it's very important to remember that it is the market that will benefit the most from those tailwinds that I mentioned around deregulation, monetary, fiscal, it's AI spending, etc. It is the best place to monetize all of that. And sometimes simple works, and sometimes simple has been working for the past few years. I don't think it is necessary to go into very exotic investments or structure into the next year, because we have the broad liquid market that should do the hard work for us. So simple, but hopefully efficient.
Well, there you go. Folks, the bull run is expected to continue, but make sure you keep cash on the sidelines for volatility and stay diversified. Alex, really appreciate you coming in today.
Thank you, Vish. Appreciate it.
You betcha. I hope you enjoyed that video. Please don't forget to like it and subscribe to our channel for more great content like this. Have a great day.